How are you, viewers and learners and all the interested parties? Today we are looking at BDA, a question on BDA. This is a paper that was done for April 2023. Yeah, it was done on 27th of April, and they were asking several questions, whereby when you look at the question number 21, so they are supposed to answer any 3 questions out of 5 questions. They were given 5 questions, you answer 3 questions. Question number 1 was testing about the net present value and the internal rate of return, IRR. Question number 2, they were supposed to do the linear, to insert a linear trend line displaying the equation and r squared on the chart, and you discuss the results. Then using MS function, show the coefficient shown in the trend line. And also you are supposed to find the regression equation. That was question number 22. Question number 23 was for the group, consolidated statement of financial position. Question number 24 was to determine the value of the company. Question number 24, they were asking about the value of the company, that is N Limited, using the free cash flow to the farm model. And question number 25, it was about auditing, whereby you have been given a list of balances here, and the closing balance is there, some errors and omission identified, and you are supposed to prepare an audit schedule for 8 columns with the following heading: the original trial balance without adjustment, the adjustments, the draft profit or loss, the draft statement of financial position, and each section should have a debit and a credit column duly balanced. So those are the 5 questions that was tested for this April 2023 sitting under the business data analysis. So today we shall start with the question number 23. This is a question that was dealing with consolidated financial statement of the group accounts, and we shall tackle this. And it was reading: the following draft financial statement relates to H Limited and its investment company S Limited and A Limited for the year ended that 1st December 2022. So I've been given the H, the S and the A, and their shillings in thousand. We have non-current asset, the PPE, the intangible asset, the investment, current asset, the inventory, receivable, cash at bank, total assets, then ordinary shares, par value is 5, retained earnings, and the shareholders fund. Then on current liability, 10% loan stock, current liability, trade payable, bank overdraft, and current tax, and total liability, and we have total capital and liability. And you go to the additional, the following details relates to the acquisition. So we acquired company S. Date of acquisition was on 1st of January 2019. The cost of investment was 750,000, that is shillings in thousand. The retained earnings on that date was 200,000, and the percentage was 80%. So you can put the 1,000 separator, that way. So this one, S we acquired 80% and A we acquired 30%, which means that S was our subsidiary because we were controlling 80%, and A was our associate because we were controlling 30%. We are told H also invested in 25 million of the loan stock in S on 1st January 2021. On the dates of the acquisition, the value of building in S and A were 50 million and 25 million above their carrying amount. Building are depreciated at the rate of 2% per annum on reducing balance. So this one means that this was the fair value gains on the building and on building of A and building of S, and we shall calculate the fair value depreciation there. The fair value of non-controlling interest, that is the purchase consideration, can be estimated from the share price of S, that was shillings 80 on 1st January 2019. Number 2, on 1st January 2021, H Limited sold S an item of plant at a selling price of 75 billion, reporting a profit markup of 50%. Plant is depreciated at 20% per annum on reducing balance. Again, here we are depreciating it on reducing balance. So this was a UPFA We shall calculate that. During the year, companies traded as follows. S sold goods at a selling price of 20 million to H at a normal gross profit margin. 1/4 of these goods remained unsold at the year end. And number 2, H Limited sold goods at a selling price of 40 million to A Limited, reporting a profit of 10 million. Half of the goods sold to A had been sold by the year end. And at the beginning of the year, H Limited had goods to the value of 10 million purchased from S Limited in the year ended at 1st December 2021. Number 4, included in the trade receivable and trade payable of each of the respective company are the following intercompany balances. Due from H to S, we had 25 million or 25,000. Due from A to H, 25,000 again. A close check in S Limited books revealed that receivable of S had 30 million due from H. This anomaly arose because H Limited sent a check of 5 million to S on 29th December 2022 but had not been received by S as of that 1st December 2022. So this one we call it the cash in transit, the 5. So we shall do the reconciliation of that. Meanwhile, all the company had paid their interest on loan stock by the year end. Number 5, goodwill where relevant had been impaired by 20% on costs at the beginning of the year. An additional impairment of 20% of the initial cost was again reported in year 2022. So at the end of the year, it was depreciated or it was impaired by 20%, and at the beginning of the year, it was impaired by 20%. So it means the cumulative impairment by the end of the year will be 40% of the goodwill that was already impaired, because from the time of acquisition until the beginning of the year 2022, it was impaired by 20%, and at the end it was impaired by 20%, so the total will be 40%. So prepare the consolidated statement of financial position as at that 1st December 2022, and it was a question of 20 marks. So we shall start this question, and I think we shall do it either down here or up here. Just to see. It will be the best place to do it. Okay, then let me do it down here, instead of doing it at that end. So I will do this question here, and I will do even my workings, everything I will do it under these, so that it will cover everything. So this is H Limited, so I'll start here, H Limited, and I will zoom this so that, okay, just a minute. So I shall prepare it here and start with our heading H Limited, H Limited consolidated statement of financial position. Consolidated statement of financial position as at that 1st December 2022. So that 1st December 2022. So I'll merge and center that. I'll increase my font size to 14, merge and center this, increase my font size to 14, control bold, even this one control bold, that way. And I will okay, yeah, that way. So that we shall start with our non-current assets. Non-current assets. So this area I need to set at 14. Yeah, and control bold. I'll do some workings on this end. Some of my workings. And the first one, we have said that we are owning, in this case we are owning S 80%, which is our subsidiary, and A 30%, which is our associate. So to look at the group structure, so S is our subsidiary, and A is our associate, because this one is 80%. No, this one is 30%, and for the subsidiary, this one is 80%. Yeah, 80%, which is our subsidiary. And I will merge that. Okay, and this one I will merge that way, subsidiary 80. And the second working that we shall be dealing with, let me deal with goodwill, calculation of goodwill of both S and A, for both S and A. So we calculate the goodwill for S and for A. We'll do for S and for A here. So let me do it here for S and for A, and you'll find that we shall start with the cost of investment. And when you come here, you'll find that we have the cost of investment. This one is our cost of investment. So for S, it was 750, and for A, the value was 300. Enter. That is our cost of investment. And after the cost of investment, we shall have the fair value, NCI, fair value NCI, fair value NCI. And the fair value NCI, that one is in S. S is the one that has got the fair value NCI, and we are told in note number this one, the fair value of non-controlling interest as a purchase consideration can be estimated from the share price of S that was 80 on 1st January. And there was a problem, because when you calculate with 80, I will show you the problem that will be there. So was that, so we shall take to get the fair value NCI our number of shares. Currently the number of shares that we have, S has a share capital of 80, and we shall divide this by the per value of 5 shillings, and we multiply by 8 shillings. Yeah, we shall multiply by 8 shillings instead of 80, and we'll elaborate that why we are multiplying by 8. There must have been a mistake, and we multiply by 20%, because the NCI share is 20%. percent, so you'll multiply by 0.2, 20%, and I'll put enter, which will give us 160 as the fair value of NCI. So the reason I've not used 80 is because if you calculate here, assuming we are using 80, yeah, it's just for an assumption we use 80, so we shall take then if we are using 80, this one the number of ordinary shares divided by the par value, we multiply by 80 shillings as they are purporting to have given us, and multiplied by 0.2, 20%, and you enter, and you'll find that we shall have 1.6 as the fair value of the NCI. 1.6 as the fair value of NCI. The problem will be now that the fair value of NCI will be even greater than the value that we had paid as the holding company, and that's why now I believe there was a mistake. Instead of using the 80, we have used 8 shillings as the fair value, the market value, so that for it to be more realistic under that. And so here the total value we shall have, so when you add this, alt equals enter that way, and here is alt equals enter, then we can just bold this, control B that way, then we less net assets acquired, less net assets that we acquired, and our net assets here shall start with ordinary shares, just put equals our ordinary shares, our ordinary shares, I'll put that okay, yeah, ordinary shares. So this one okay, yeah, leave here. So our ordinary shares, I'll put a minus because we needed to minus to get the goodwill. It will be minus we were having what as our ordinary shares, 500,000. Then for A, yeah, for A we'll take our percentage. I'll minus I'll put equals to bracket minus the value that we had here. We had 400 and our share is 30%. Our share is 30% to get 120,000. Then I will come to the retained earnings, and for the retained earnings or retained profit, we normally use the pre-acquisition. So I'll put minus. So our pre-acquisition here, the retained, which was 200,000, and this one we put it as minus. This one you're calculating as a bracket minus. So our retained, the pre-acquisition, the date of acquisition was this, multiplied by 30%, and I enter that. Then we had the fair value gain for the plant. So the plant had a fair value, we are told here, yeah, on the dates of acquisition, the fair value of building. So this was the fair value gain for the building in S, and A were 50 million and 25 million above their carrying amount. So fair value gain, this one is for building, fair value gain for building. So this one we shall minus 25,000, and this one we shall minus it was 12 what 25. So the first one was 50, sorry, this one will be 50,000, so minus 50,000. Sorry, that cell is active. Yeah, this one is supposed to be minus 50,000, and this one is supposed to be, I'll open the bracket, minus 25,000 by 30%, multiplied by 30%. I will enter that to be 7,500, and I can format this area so that any value that I'm using as a negative, it will show me using brackets. So I'll format this, I'll custom format, and I need to use this. So here I'll use bracket, and at the end I'll put bracket so that it will capture bracket, yeah, that way. So that one is okay, and I'll get my goodwill here, my goodwill on acquisition. So here we'll put alt equals, yeah, so from this point, and I will enter, and the same here, I'll put alt equals, yeah, I'll extend this to that point, I'll put enter. So our goodwill, we had 160 and the other one was 82,500. Remember we had goodwill impaired, and cumulatively it has been impaired by 40% cumulatively, because they're saying at the beginning of the year it was 20 and an additional 20% at the end. So cumulatively is 40%. So we shall take this multiplied by 40, 0.4, and the same here, which will be equals to this value by 40%, and I'll get our goodwill unimpaired, goodwill unimpaired, and our unimpaired goodwill. So alt equals, so these two, okay. So before that, so the goodwill impaired is supposed to be a negative. You just include a negative sign there. Even this one, you just include a negative sign here, yeah, so that here now we shall put alt equals, okay, alt equals the two of them, I enter, and the same here, alt equals the two of them, I enter, that way. So those will be our goodwill that was not impaired, yeah, that way. And we are done with the calculation of goodwill. The next thing we shall need to do calculation on is fair value depreciation. Yeah, to me do fair value depreciation. I just start it here, hoping it will not affect fair value depreciation. Fair value depreciation, and for the fair value depreciation, this was on building, for S limited, for S limited, we are told depreciation is calculated here on the date of acquisition as an 50 and 25 above their carrying amount. Building are depreciated at the rate of 2% per annum on reducing balance. When you look at S, when did we acquire S? We acquired S on 1st January 2019. So we are having 2019, 2020 will be 1 year, 2021, so 2019 is 1 year by the end of 2019, 2020 second year, 2021 third year, and 2022 by December 4th year. So it means this building from the date of acquisition when we acquired it on 1st January, it has depreciated for a period of 4 years, and we need to calculate the cumulative depreciation for those 4 years because we are preparing the financial position, and we shall get it. I'll use the formula for the reducing balance. So we shall have 50,000 that was our value, 50,000, and multiplied by, I will open the bracket, 1 minus 0.02, I close the bracket, I will raise to power 4. This one, what it will give us, let me just put equals to, this one what it will give us is the net book value. The net book value at the end of year 4. By the end of year 4 it will give us the net book value of this particular building. So it had a net book value of 46,118. Therefore the depreciation will be I will take 50,000, that was the initial cost, and I minus this value, I minus that, so we have a depreciation of 3882. 3882 as our depreciation on building of S. When you look at depreciation of net book value, NBV for building, NBV for building of A limited, So for A limited, we shall have, the value was 25,000, the fair value, it was 25,000, and I will multiply by 1 minus 0.02, I close the bracket, raised to power. So when you look at now the one for A, the time that we acquired A, the date of acquisition, A, we acquired it in January 2020, 1 year after acquisition of S. It means this building that we are depreciating for A, it will depreciate 2021 year, 2021, 2022. So it will depreciate for 3 years. For a period of 3 years. So I will raise to power 3 and I enter. So we shall have 23,530 as our net book value. Then therefore our depreciation will be, for it will be equals to 25,000, and I minus this value and I enter. So 1470 will be our depreciation for that particular building. Then there was another, so that was our working for that, for fair value depreciation, you can call it working number 2, and we had what we call, that way, we just just a minute, merge and center this in order to reduce the space. That way, and that one is okay. So that way, so we now calculate what we call unrealized profit on fixed asset, UPFA, unrealized profit on fixed asset, unrealized profit, realized profit on fixed asset, fixed asset. This one you normally call it UPFA, and realized profit on fixed asset. So we are told that we sold an asset that was in note number, note number 2. On 1st January 2021, H Limited sold S Limited an item of plant. This was a downstream transaction. H is the one that was selling to S an item of plant at a selling price of 75 million, reporting a profit markup of 50%. Remember, when you report a profit markup of 50%, it means that this profit we shall only realize it at the time of sale of this asset, and that's why we are calling it unrealized profit, because at the time of the disposal of the asset, that is the time the profit will be realized, unless now the asset is sold. Before that, we shall categorize that as unrealized profit. So we shall come and calculate it. Our UPFA here, unrealized profit on fixed asset. So this one will be equals to 75,000 because it was 75 million. We multiply by 50 over, because it was a markup, 50 over 150. Yeah, 50 over 150. So our markup was, our unrealized profit was 25,000. Then we calculate what we call the fair value, depreciation overcharge. Depreciation overcharge. Depreciation overcharge. We are calling it overcharge because they calculated based on 75, which was already overcharged. Yeah, so they shall need to reinstate or to recalculate and readjust that value because it was overcharged. But for this one, this was fair value depreciation. We can add a word at the end. Just a minute. This is an undercharge. Deep undercharge, because the value that we used was less than the fair value. So this is an undercharge, but this one is an overcharge. So for the overcharge will be equals to, we are told we are calculating this depreciation based on what? It was note number 2. Yeah, 50% markup. 50% markup on plant is depreciated at 20% per annum on reducing balance. And remember, when did we sell? It was in January 2021. So those are how many years? January 2021 and 2022. These are 2 years. So it has depreciated for 2 years. So the first thing then we shall first calculate again is the net book value here. Before we calculate our depreciation undercharge, yeah, before we calculate this, let me just cut this and put it somewhere here. Let me paste it here. Here we first calculate net book value, NBV. Our net book value therefore will be equals to this value multiplied by into bracket 1 minus 20%, 0.2, and we raised power 2 because this one it has depreciated for 2 years using the reducing balance. So we have 16,000 as our net book value earning, and therefore, so in this case now we shall calculate our depreciation overcharge as this value, and we minus this value. Yeah, that way. So our depreciation undercharge is 9,000 as our depreciation undercharge. So we are moving on well, and the next thing that we shall need to calculate, there was an intercompany. So we are done with note number 2. Number 3, during the year end, the company traded as follows. S Limited sold goods at a selling price of 20 to H at a normal gross profit margin. 1/4 of these goods remained unsold, so they are selling at a normal gross profit margin. So remember here, if we base on this note number 2, they sold at a markup of 50%. Yeah, so if the markup was 50%, the margin will be what? That will be the question. If the markup was 50%, what will be the margin? Because they are using the normal gross profit margin. Yeah, the normal gross profit margin. And if the markup was 50%, we shall come and calculate that. So this one is our intercompany sale, H selling to S. So we calculate that here, our intercompany sales, and this one is H selling H to S, and our selling price, yeah, selling price we know it was, our selling price was 70 what? Selling price of 20 million. Yeah, selling price of 20 million as a selling price of 20,000, and we calculate the markup. Markup was the markup was 50%. Yeah, whereby when you take 50%, 50 over 150, yeah, if our markup was 50%, this will be 50 over 150. 50 over 150. Sorry, 50 over 150. Okay, So it is giving me a 0. Okay, is equals to can change this into a number. So 50 divided by 150, so 0.33, and we need to convert these now into margin. So remember, ideally when you take it as a fraction, 50, it's normally a third. Yeah, this is a third, and if this is a third, to get a markup, when you convert that into a margin, margin will be a half, because we normally minus. So assuming this is a third, we normally minus 1 in order to arrive at a margin. So our margin therefore will be half. Our margin will be 0.5. Yeah, 0.5. So this one we need it to be a number again. Yeah, 0.5. So markup was 33%, and margin will be 50%. Therefore, our unrealized profit here, our UPCS will be equals to this value multiplied by this margin multiplied by how much remained? A quarter, by 1/4. A quarter is the one that remained. Yeah, a quarter is the one that remained. We'll enter, which will give us 2,500. Okay, yeah, 2,500. Just a minute, just need to confirm something there. Okay, so 1500. Okay, yeah. Okay, so this one I'll do a little bit of correction here. Markup was this. This one will not be a half, but it will be a quarter. Yeah, it will be 1/4, which will be 0.25. Yeah, 0.25, and therefore our UPCS will be 1250. That will be our UPCS. But there was another thing here that we are told. So that was this one that we had sold. There was this statement here. So 1/4 of these goods remained unsold at the end of the year. I believe that one already we have factored in. Let's just confirm that. Yeah, that one already is factored in, because already we have multiplied by a quarter. But the one that we have not factored, so we have this one. That was at the beginning. There was this statement. That was at the end. At the beginning of the year, H Limited had goods to the value of 10 million purchased from S Limited in the year ended that 1st December 2021. So this was at the beginning. We had 10 million at the beginning of the year, yeah, which already had been purchased from S Limited. So this one is unrealized profit on the opening. Unrealized profit on opening stock, UPOS. This will be equals to it was 10,000, and you have seen our margin is 25%, that way. So it means at the beginning of the year it was 2,500, and at the end of the year it was 1,250, which means it has reduced. Yeah, decrease in provision. That one will be a decrease in UPCS, so it has decreased, which will be an income, this, and we minus this, so there was a decrease of 1250 in the value of the UPCS. We calculate the one for the other part that we are leaving, this part. H Limited sold goods at a selling price of 40 to A, reporting a profit of 10 million. Half of the goods sold to A had been sold by the end of the year, so half of it already had been sold, so the other half has not been sold. If we had already sold half, it means we realized profit halfway, the other half was yet to be realized. So this one is UPCS on associate, because H selling goods to A, so profit of 10, so H to A, yeah, and realized profit, or we'll just put this intercompany sales, and yeah, this one is H to A, intercompany sales, H to A. Okay, so just write it here, intercompany sales, intercompany sales, this is H to A, and we'll find that our UPCS will be is equals to, the profit was 10 by half, 0.5 that remained, that was our unrealized profit. And I think that's all that we had. Already we have calculated the goodwill. This was the intercompany, yeah, we shall deal with that. Yeah, we're done. We can now start with our consolidation. We start with consolidation now. Our non-current asset, we shall have, so we are consolidating H and S because A is an associate. We shall calculate the value of an associate, investment in associate. So we had our PPE there, our PPE, and our PPE, I think I'll do it, yeah, you can do it in this space here, shillings in thousand, yeah, this is shillings in thousand of shillings, and the value here will be equals to, we shall take this value for H, we add the value for S, that way we add, there was a fair value gain, so because the other side we have a minus, I will minus, because this one was a minus, this fair value gain on building, I will click that, because that one already is a minus, and we minus the depreciation. There was a depreciation value, yeah, this value of depreciation, yeah, depreciation and a charge, I will minus that, and I will minus the UPFA, I minus again the UPFA, unrealized profit, this one, and I will add the depreciation, that was overcharged, the depreciation overcharge of 9,000, because that value was overcharged. I will put okay, so that will be our value, yeah, that will be our value there, it will be our value. I will round it off and remove, yeah, that way is okay. So the second one, yeah, the one that we have, we shall go back. The second one is intangible asset, and intangible asset we shall have equals to, that's just but a simple, we don't have anything, this one, and we add the one for S, and we enter, then we come to the investment, our investments. So our investments we shall have equals to the investment for H, we add the investment for S, we minus what we had invested internally, we minus internally. So internally we have invested this and we have invested in this, and we minus the 25,000 that we had invested for what? For the loan stock. H also invested 25 million of the loan stock in S, so that we remain, the objective is to remain with external investment, and you'll find that our external investments were 60,000. Then the next thing, we have goodwill. Yeah, we had goodwill here, goodwill, an impaired goodwill, and the value of an impaired goodwill here we had 96 as our value of an impaired goodwill. Then we shall calculate investment in associate. We not calculated that. Investment in associate, investment in associate company, investment in associate company, and our cost of investment, our cost, I think I had that right up, and we are calculating this, yeah, cost of investment here. And in associate we invested 300,000, we had that value as what we had invested. Sorry, our cost of investment, let me just put it here, we are having 300,000. Then we shall less, not even less, we shall add the post acquisition profit. We add the post acquisition profit, the post acquisition profit, which will be, I will open the bracket, the profit at the financial position, profit at the financial position, our retained profit for this, it was 470, and I will minus the pre by the time we are acquiring, so it had a retained profit of 300, and I will close the bracket and I multiply by 30%, because that is the percentage that we are owning, yeah, 30%. So shall have 51,000, and we minus our share of the depreciation, deep on building, yeah, deep on building. So remember the depreciation on building, we have calculated it here, yeah, depreciation on building, which was 1470, yeah, 1470, yeah, 1470, we multiply by our share, which is 30% of that, and this value shall minus, because that is an expense, shall minus that. The other thing we had is a goodwill impaired, yeah, goodwill impaired, we had it somewhere here, goodwill impaired, and the goodwill impaired, we had it here, the goodwill impaired was 33, that was our portion, 33. Now let's the UPCS, yeah, the UPCS here, we had our UPCS here, the whole amount, which was 5,000, so I'll put a negative, that value, yeah, negative 5,000, and I'll get the value here, alt equals, enter, yeah, this will be our value. You can use top border, and I can use bold, yeah, this is the value of investment in associate. So I'll come here in my statement, I'll put equals to investment in associate, I enter that, and the value of our investment in associate is that value, yeah, so that is the value of investment in associate. So you can get the total here, alt equals, and I enter, that will be our total non-current asset. So we go to current assets, current assets, just pick the wording here, our current assets, and can just put bold to this. In the first current asset, we shall start with this inventory. Add inventory, enter, and our inventory, we fix it here, shall have inventory for H, we add inventory for S, and we shall adjust these. In this case we shall add the UPCS because it was a decrease in UPCS. Remember our UPCS decreased, so this is a decrease in provision by 250, so we shall add by 1250 that decrease, and I enter. That will be our value of the inventory there. Then I will come to the second. After inventory, we are having receivable. I enter. My receivable will be receivable. I will take this for H. I add receivable for S, and for the receivable minus the intercompany. Yeah, we are told in note number 4, include in trade receivable and trade payable of each respective company at the following intercompany balance due from H to S, which was 25. But here cross check in S limited books revealed that the receivable of S had 30 million due from H. This anomaly arose because H sent a check of 5 million to S on 29th December, but had not been received by S. So you'll find that there was an intercompany cash in transit. So we shall minus in the receivable 30 and we shall add in the cash 5. So here we minus 30,000. I put okay. That will be our 215 after minusing that. Then we have the cash, our cash at bank, which will be equals to, so we shall have cash at bank. So we had 100 for H, and we add the 5,000 that was in transit. 5,000 that was in transit. We shall get the total here. Our alt equals, okay, so equals, we'll put the sum, our sum, yeah, I'll sum the three of them that way, and I enter, so that here you shall get our total assets. In total assets, I'll put alt equals, and I'll adjust this to cover these two, and I put equals, so I shall get 4317 427 as our total assets there. Total asset, so I'll use top border and bottom, and I will put the bottom border to this bottom border. So here we'll put top border, yeah, that way. So we go to the next category, yeah, here, and in the next category we are having the equity. So current, so just go directly to equity. Okay, so here you can use both double lines, yeah, to use that for double line for that. Equity and liability, equity and liability, equity and liability. Equity and liability, and we'll start with ordinary. Just pick the wording ordinary shares, and our ordinary we normally take only the holding company. We don't consolidate for the ordinary shares, only the holding company. So the ordinary shares we don't consolidate. So the next thing is the retained. We shall calculate our retained earnings. We just pick the wording for the retained earnings. So I'll do that as a working. Let me do it here. The retained earnings. And just still pick that word here. The retained profits. Retained profits. Retained profit. So we have for H. So H had retained profit 1385. We had for S we take the post acquisition, our share of post acquisition, and remember in the financial position we had 365. We minus the pre was 200, and we take our portion, which is 80%. Okay, yeah, multiplied by 80%, yeah, that way. Then we have for A, again we take the post. I think for A already we had it here, which was 51,000, which was 51,000 already. So that is our retained for H, for S, and for A. Then we add the next thing here. We shall calculate the goodwill impaired. We had goodwill impaired, which will be, we take our portion of the goodwill impaired. Goodwill impaired was 64 multiplied by 80%, and the other one still goodwill impaired. The first one is for S, the second one is for A. So for A we take the whole amount of goodwill impaired because already it was our percentage. The next thing is UPCS. UPCS over A, the whole amount of that UPCS, and the other one still is a UPCS. Yeah, the decrease in UPCS. This one we shall add. Yeah, that one we shall add the decrease in UPCS. Then we had the UPFA. We shall minus UPFA, realized profit on fixed asset. This one we shall minus this value, realized profit on fixed asset, and the depreciation for value depreciation. Yeah, it was a depreciation overcharge. We take our portion, whereby we shall add the overcharge by 80%. Depreciation overcharge. I think we have put everything that you were supposed to include. So for value depreciation, there were two of them. Yeah, we had the one for 14. Yeah, this one was for A. Yeah, there was again that fair value depreciation for A. Yeah, we had this depreciation, which will be 1470 30 by 30, and I will enter that. Which will be 441. Just reduce that. Yeah, 441, and this one we shall put a minus. Minus that. Yeah, minus 441. I think that's all that we had. So the other depreciation, yeah, we had this other depreciation. Yeah, there is that other depreciation. This depreciation, which will be equals to this one multiplied by 8, our share, and we put minus and just 2 decimal place to that. Yeah, that way, and just continue formatting this in order to include the negative sign. Yeah, bracket, to change that into bracket, and bracket at the end. Yeah, that way. I think that's all that we had there. I believe we have captured everything that was supposed to be captured. So use alt equals to get the total there. Yeah, to get our total there. So that's our total of the retained profit. So shall come here, put equals to this value, we enter, yeah, 1458. Get the shareholders fund, shareholders fund, and our shareholders fund, and it equals the two of them. Then in CI share of net assets, and CI share of net assets. So I shall do that as the working here, and we will find that again this point. Yeah, we change this, yeah, to 14, and okay, so we will calculate it here. NCI share of net assets, and we start with the fair value NCI. We had it somewhere here, fair value NCI, and the value of the fair value NCI, we had 160,000. We had the post acquisition profit. Yeah, we had the post acquisition profit, which will be our post acquisition for, no, let me not use that. I'll open the bracket, post acquisition profit, where we'll take our profit for S, I minus the pre, which was 200. We close the bracket. Our share of NCI is 20%. Yeah, multiplied by 20%, and I enter, which we shall have 33,000. Then I'll take the share of the goodwill impaired. Goodwill impaired. Now goodwill impaired I'll take to 64,000, and I will multiply by 20% our share, which is 12,800. I'll take the fair value depreciation, our fair value depreciation here. Our depreciation was this, and I'll multiply by 20%. Yeah, this one is supposed to be a negative, value, and after that we have the depreciation overcharge. Depreciation overcharge here. and overcharge we shall add our share of this by 20%, 1800, and we add the UPCS, decrease in UPCS, and then they'll take a share of the decrease in UPCS, which was this, by our share of 20%, should be 250, and I'll put alt equals and I enter. So that will be our share of the NCI share of the net asset. So this one will be equals to this value. Is it this value? And I enter. So shareholders fund, so this one is attributable. This one actually is not shareholders fund, attributable to holding, attributable to holding company, attributable to holding company. So shareholders fund, alt equals, so you just need a sum of the two, and I enter. Yeah, that way. So here I'll put the top border, and here I'll also put the top border, and I bold that. Then after that we shall have what we call the non-current liability, and under non-current liability we shall take the 10% loan stock, which will be equals to this. We add this and we minus the 25 that was intercompany. 25 that was intercompany, shall get 150 there, 150. So I'll reduce the decimal there, 150. Then we go to current liability. Here our current liability is this, and I'll bold this. I bold this as our current liability. So under current liability, the first thing we have is the payable, the trade payable, and the trade payable will be equals to for the payable, let me just do it here, equals to this value payable plus this value, and we minus the intercompany of 25. Remember there was cash in transit of 5, so here just minus 25,000. The second category we had the bank overdraft, and for the bank overdraft we had what? Bank overdraft, this one. I enter, and the last category there we had the current tax, and for current tax we shall take this, we add this value, and we enter. I think that's all there. So here alt equals, just adjust this, just adjust this to capture that, and here we shall have what we are calling total capital liability. Let me just check this. Total capital liability, alt equals, adjust this to cover up to that point, that way, and you'll get that here we have 4317. Here I'll control bold 4317, 677, 43 total assets 4317 427. So there is a slight, just a slight difference. We shall see where the difference is coming from. That way you'll find that it's just but a slight difference. So when you look at our question, we had a minimal difference where we are having 4317 677, and this one is 4317 427. And the main reason, when you look at our decrease in UPCS, was 1250. Here we're supposed to take our portion. In this value we take our portion. We'll multiply this by 80%. Our portion, just our portion, which will be 1000. This will change, and when you look at our question already, it has balanced at 4317 427, 4317 427. And that's how this particular question, it was a long question, as you can see so far you have taken almost more than an hour doing this, and that's how the question was supposed to be done. How the question was supposed to be done for you to get your 20 marks. So we have our workings on this end. These are our workings. We have started with S and A, subsidiary and associate. Then we have calculated the goodwill for S and goodwill for A. Goodwill for S and goodwill for A. That one we have calculated. We use top border. Then we minus to get our goodwill. There. Then goodwill impaired, and we remained with our final unimpaired goodwill. And all those are the workings that you're supposed to do: the fair value depreciation, the unrealized profit, the intercompany sales, H to A, investment in associate, the retained profit, the NCI share, of net assets. And you find that after doing that, you'll have to balance, although it will take you some time, but actually it was a question with speed. It's a question that was doable. So that was question number 23 for April 2023, sitting for the BDA. So the other questions will be solved in due time, and we believe you'll be able to follow. So that's how that particular question, the consolidated statement, was supposed to be done, how it was supposed to be done. And I believe we'll be able to follow that. We'll be able to, if there's any question regarding this, you can as well as text or zap, so that you can get any clarification that you require on this particular question. Thank you for your time.